And if you would call the roll, please.
Certainly. Sue Burton.
Here.
David Harrington. Matthew Crutcher.
Here.
Mark Munson.
Here.
Landon Moore.
Here.
Laura Bellin.
Present.
Gary Waters.
Here.
Derek Challenger.
Present.
Solomon Ashby.
Here.
Elizabeth Gooden.
Present.
Cheryl Spivey.
Here.
Is here. You have a quorum, ma'am.
Thank you very much. Has everybody had a chance to review the minutes?
I make a motion they be adopted.
Is there a second?
Second.
All those in agreement, please say aye.
Aye.
No opposing. All right, the minutes are passed. Did we have any applications for retirement?
No, ma'am, we did not. No applications for retirement, no reported deaths.
All right, and we still have the active participants.
I got my list from John Hancock and did discover some discrepancies between what we had and what they had. And those discrepancies were 2 members of fire and police that were being incorrectly recorded as supplemental, as well as a member who was on the supplemental who should not have been included.
Okay, so now the numbers are 20 and 15.
Yes, ma'am.
Okay, excellent. Do we want to move on to the recurring business reports and the schedule of historic funds?
Certainly. This is the total year-to-date. So for the full year, year-to-date, you had a beginning balance of $230,630,954.83. Your interest income, $5,881,345.09. Administrative expenses were $195,899.09. Return of benefit payments, $51,987.96. Recurring benefit payments, $30,339,948.93. Employer contributions, $8,823,645. Your realized gain was $2,014,480.24. Your unrealized gain was $2,243,748.47. The net change for the year was a loss of $11,520,641.26, leaving you with an ending balance of $219,110,313.57. This is a change from last year of $11,520,641.26.
Any questions or comments from, kind of like even though we made money, we still sent out a lot of money?
Yes.
All right. Are we prepared to move on to the next item, the OPEB trust status, which I saw you included in
Yes, I did. The market value as of the end of the year, keeping in mind we only had this invested for, I believe, 3 months, was $3,046,475.21.
Any questions? All right. I think we're ready to move on to unfinished business. Do we want to ask our attendees to please step out for just a minute
Yes.
while we get the report from the investment committee? Thank you. Mr. Ammons, are you up?
Okay. Madam Chairperson, members of the board, staff.
We've met and we've made a selection, and today we intend to award this contract to Greystone. And so, based on the recommendation of the board, going through the whole RFP process, evaluations, interviews, negotiations, we've made the choice and we intend to award it to Greystone Consulting.
Anybody have any questions?
Madam Chair.
Yes, sir.
Please understand, you're still in a public manner. So what I would suggest, to the extent that there is an issue, we may need to go to a closed session, but we will be asking you all to bring them back in and adopt a motion, a ratification of the investment committee's
Right.
selection process shortly thereafter. But if there's any in-depth discussion, process or otherwise, we would need to go
Into close.
into close.
I had one question I wanted to ask.
Is it a public discussion or?
Well, the matter was regarding which type of management were we going to award? There was the option, so that's what I wanted to know.
And
The options were, we asked for non-discretionary and we asked for discretionary. So it's the recommendation of the panel that the fund manager will be a discretionary fund manager.
And we will have that discussion in this interim period as we address the contract issues and whatnot. So that will be addressed going forward.
Okay, very good.
All right, are we ready to let them come back in and?
But we still can't tell them yet?
Oh, yes. I mean, you will, as soon as we move forward, you will be asked to adopt or a motion of intent to award, and it will name them. So,
Today?
yes,
With them here?
yes.
All right. Hopefully we all agree.
Well, that's what,
If not,
that's what this time period was for.
Nobody asked any questions, so I guess you're okay with it.
You address.
Thank you, Mr. Ammons.
I'm good with it. Are you good with it?
Yes. Yeah, they're pretty
And
good.
let me say this, Madam Chair, for the benefit of the body, so we can move forward. The investment committee has recommended a notice of intent to award to Greystone. Given the manner in which we selected, it would be appropriate to have a motion to ratify that selection. We do still have other processes in order to complete that, but that is where we are as it relates to the investment committee's work.
All right, whoever's going to make the motion, are you able to frame it in such a way to take that into account?
It would simply be a motion to ratify.
I move that we ratify the recommended decision of the investment committee to award the contract to Greystone.
Second.
All right. All those in favor?
Aye.
Opposed? All right. Well, welcome and thank you very much.
Well, that's about the best introduction one could possibly ask for.
There is one little tiny thing, sorry to interrupt, just a couple little tiny things. Everybody received a copy of the board members that will be rotating off at the end of September.
Correct.
Just wanted to make sure
And now
everybody knew that.
We understand how that process works, why it said 2018 with an unfinished term and all of that, so.
I don't. Can you clarify it?
Oh, okay. Mr. Moore was appointed just, 4 months ago, 5 months ago? And he had wondered why his expiration date was September, this upcoming September.
Right.
But that's because the person that he replaced, their term would have been up
Okay.
at the same time. I know I came on with somebody's unexpired term, so that means then that you still have 2 more terms to serve if council submits your name and if you agree to serve for another term. So that's how that works.
Yeah, I guess they just want to keep all the terms concurrent.
Right. And that does mean that, there are 3 of us. I didn't realize that, that you were also
I didn't.
came up. So, but I think maybe you still have an option for reappointment.
No.
So- No, he does not?
No.
Okay,
You are both on your second term.
all right. I knew I was.
I've asked not to be reappointed.
Okay, Mr. Waters. Appreciate knowing that. Somebody's going to have to go out and beat the bushes really hard to see if we can find some new members for this board, so.
So that being said, if we're looking at losing 3 in September,
4,
4 in September,
3, if Mr. Moore is reappointed.
okay, 3 or 4, either way, that would potentially cause some issues. What other recourse do we have at this point until we find new people?
Madam Chair, members of the Retirement Board, and I serve a number of boards, but I want to say the rule is you serve until you are replaced. You carry over until you are replaced. And to answer Mr. Moore's question, all of the ordinances have particular time schedules from the initiation of the board, such that you don't have an entire board that all switches over at the same time. So in just about every board, there's a stagger and a fixed term, such that you will never have a majority of a board time out at the same time. And so I'm aware, I know that the clerk's office is aware. They are putting in the processes to poll the relevant not constituencies, I was about to say contingencies, so that we can make sure we have someone to replace and see who that will be. But the typical standard provision is you serve until you are replaced. But the clerk's office is already aware of that and moving forward.
Okay, so that gives them not quite 2 months to find somebody.
Correct.
And if in those 2 months they don't fill those positions, then those of us that are up are here until they find it, until they...
Correct.
Okay.
That's the standard rule. I don't think your rules are different.
Okay.
So how does the replacement go? If you get one person on, who goes first? Is it alphabetical? Because I looked at I looked at the dates here, and they're all the same.
Well, originally, let me speak to the original composition. Ms. Burton
Can I go first?
serves in a capacity as a supplemental retiree. And so she has a particular constituency. Sergeant Crutcher has another constituency.
Yes.
So those two, there's a set number of individuals where those applications will go forward. As it relates to Mr. Moore, of course, he has an opportunity to be renewed, so that may not be an issue at all. And I believe the sheriff is in a citizen's position also. So again, it's just a matter of getting another citizen. So there isn't a first, second, third. It is pretty regimented, but we know, and we've been pursuing it for a little while in terms of getting prepared, so we can get as close to that termination period as possible in terms of getting a replacement.
Now, because there's so few numbers left, what happens if you don't find somebody from those constituencies?
Well, if you all will recall, I believe it was the 2015 or the 2016 City Council that said they removed the obligation, but agreed to continue to try to meet those needs.
Okay.
Because that number was dwindling. And so that's what I've had the discussion with staff and the clerk's office. We're going to pursue in those categories first and foremost. And if we have a difficulty, then we'll go to the citizenry.
Okay.
Because that's what I thought I remembered, is that there was no longer a requirement,
Right.
but that they would try to have one or two members at least from the one or the other of the retirement funds, so, or people. Anything else? All righty then. We have to approve a John Hancock invoice.
And I'm sure that Tom can probably explain these invoices a little better. I believe you usually reference this in your report. I believe it's the quarterly invoices that we get where we have to pay the...
Yeah, so the core, and I can go over I know if some individuals haven't had an opportunity to go through the calculation, I will walk through that. But that is our quarterly base record fee.
Is there a motion to approve?
A motion to approve.
All those in favor?
Aye.
Aye.
All right. You will get paid this quarter. And on the back, you've got the revenue analysis.
That's what came with it, and I figured
Right.
let me go ahead and merge the files together, and that way you could see how it related back to everything.
So if anybody had any specific questions.
Do you want me to talk through that at all, or do you want me to just cover, because I know my quarterly update usually looks a little different than that. I can do it during my section, or I can...
Why don't you just do it during your
Okay.
section? If questions. All right. Are we now ready to move on to the quarterly investment review? Are we going to start with Greystone, since we've got Brian on the phone?
I'm going to dial him in right now. He's on vacation with his family, so thank him
That's
for
very
joining
nice
us.
of him.
Hello, good morning.
Good morning.
Good morning,
morning.
Brian. How are you?
I'm doing well. Can everybody hear me okay?
Yes.
I believe so.
Okay.
Terrific.
Thank you for making yourself available on your family vacation. We appreciate your commitment.
I'm happy to be here.
Great.
Is he happy to be where he is, or...
You're happy to be there. That much we understand. Brian, before we begin, I'd like to share with you the good news that we just received from the board. The investment contract has been appointed to Greystone Consulting.
Well, that's terrific. And I know I speak for Jim. We're both very excited to continue our relationship with the board and look forward to many years of successful partnership. So thank you for reappointing us.
So on my behalf, thanks very much for your continued support and confidence. And what we can tell you is that we'll continue to work as hard as we can to drive value for this portfolio. We understand who the beneficiaries are, and we take that responsibility very seriously. So many, many thanks for your confidence in us. We really appreciate it. I'm going to ask you to turn to our handout, our deck, beginning on tab 1. I'll review the market's performance, and then I'll spend a little bit of time reviewing our outlook on the capital markets, and then I will turn it over to Brian, and he'll review the portfolio for us. So I'm going to ask you to turn to page 6, tab 1. So after a very volatile start to 2018, the market did find some relief in the second quarter. Recall that we did experience about a 10% correction in the first quarter. However, the environment remains challenging for equities, while the U.S. economy continues to perform very well. The construction of protectionist trade policy by the Trump administration against our major trading partners has created quite a bit of consternation for equities. Despite that, most equity markets around the world were, you'll see in a few minutes, performed flat up a little bit with the exception of the emerging markets. So let's dive into the U.S. markets for a moment. This is on page 6. The widely followed Dow Jones was up about 1.26% for the quarter. The tech-heavy NASDAQ was up a whopping 6.6% for the quarter, and the S&P rose 3.43% for the quarter. 7 of the 11 sectors in the S&P finished in the black. Energy led the way. That was up 13.4% for the quarter as oil prices rebounded over $70 a barrel. That was followed by consumer and technology stocks up a little over 8% and 7% respectively. The losers for the industry were mostly the financial service stocks, which were down about 3%, widely held. So at the very bottom of slide 6, I want to just point out one or two things. S&P 500 up 3.43% for the quarter, offsetting some of the losses we experienced in the first quarter. The Russell 2000 small cap stocks, which we're going to spend a few minutes reviewing in some detail, was up a very sharp 7.75%, and we'll discuss why that's the case. Like every meeting, these numbers are a little stale by the time we get together. And I think the good news for us all is that the S&P 500 is now up over about 7% for the year. And the market continues to discount the probability of severe trade wars with our trading partners. At front and center of that is China. Most professional investors view this as a risk, but don't believe that there will be a full-scale trading war with any of our major partners. The Trump administration appears to be trying to rebalance the scale of trading with our partners. So really off to a really good year, all things considered, all the noise, and that S&P 500 is our biggest weighting. We've got $35 million there. And that was the money that we rotated out of a very conservative and defensive Schaefer-Cohen premium dividend. If we turn to slide 7, we'll look at the international markets for a moment. It was a generally difficult quarter for international markets, and that was driven principally by a strengthening U.S. dollar, and I'll explain more about that in just a minute. And as I mentioned in my opening comments, it was a particularly difficult quarter for emerging market equities, of which we have an exposure to. At the bottom of slide 7, you can see MSCI emerging markets was down about 7.7% for the quarter. The MSCI index was basically flat, down 0.8%. That's Europe, Australia, Far East. If we look at Europe, down just a little bit, you can see it was down about a like amount, 87 basis points. Japan was down 2%. So when we stack rank all of these global indices against the S&P 500, which you see the second from the bottom row is up 3.43%. Clearly, the U.S. stocks were the winner, and that's just a result of how well the U.S. economy is doing here in the U.S. Just a word about the performance of international stocks for a moment. So the currency played a pretty big role. The dollar was quite strong in the quarter, and this is driven by Federal Reserve rate increases attracting U.S. dollars to the United States. And when we convert the performance of international money to U.S. dollars, there is going to be an impact. So if we look at the first performance box, MSCI EAFE down 0.8%. If we looked at those results in local country terms, those were up about 3.5%. And if we look at the emerging markets, that was still negative for the quarter, but it was down about 3.5%. So that gives you a flavor of how much was driven by currency and how much was driven by the actual capital market returns. Just a word about the emerging markets for a moment. We have an exposure there. They tend to be quite volatile. But over the long term, we believe that's really where the growth is going to come from. We are in a very strong cyclical upswing here in the United States. And part of it is driven by low interest rates. Part of it is driven by lower tax policies. But that will only last so long. And we're despite the quarter in emerging markets, we're going to still maintain our exposure there. As a matter of fact, the fundamental trends in the emerging markets haven't changed since we made the original investment. There are more countries in the emerging markets that have been upgraded by the major rating agencies since 2013. So fundamentals remain strong. It's not uncommon for emerging markets to get battered when the dollar strengthens. On slide 8, we're going to look at the U.S. bond market. The bond market registered slightly negative returns for the second quarter, and this is measured by the U.S. aggregate Barclays Ag Index, a general measure of the bond market, which fell 16.16%. So the widely watched 10-year U.S. Treasury, which is trillions of dollars of assets are priced off of, rose for the quarter to 2.86% from 2.74%. And I think importantly, intra-quarter, that 10-year Treasury hit a high of 3.11%, and that represents a 6-year high in interest rates. And Brian will touch upon this in our conversation about our managers, but we do have a number of managers that are very well hedged against rising rates. So, if we look at the key bond indices at the bottom of slide 8, we can see the index I mentioned was down 0.16. The Barclays high yield junk bond index was up 1. It's because of their high coupons and strong economy. And the long government bond credit was down 1.45. So the longer the maturity of the underlying bonds, the worse performance because interest rates went up. Any questions about the quarter? If not, I will ask you to turn to tab 2, and I'll spend a few minutes going through our our thoughts on the capital markets. Beginning on page 21 on tab 2, this is something that we've been talking about since the beginning of the year, and that this is what this slide depicts, and that is there have been a series of rolling bear markets, so significant declines in different asset classes, moving on from one to the next. And you can see early in the year, Bitcoin, which was all the rage, particularly with traders and speculative investors, is down a whopping 70% since the beginning of the year. If we look at European banks, they're down about 20%. Some of the emerging markets are down about 20%. Italian bonds down a little over 13%. Consumer staples down almost 18%. And if I showed you the list of consumer staple stocks, you would in the S&P 500, you would recognize them all. So these are the food and beverage tobacco companies, General Mills, Procter & Gamble, Colgate, down 18%, and that's really primarily driven by the Amazon effect.
This is since when? This year?
This is this year, yep, as of July 6th, year-to-date July 6th. Airlines down 23, certain emerging markets debt down 10.5. So I share this with you because this is our view that these rolling bear markets will continue. And as an asset class gets hit, until it stops going down, then the market rotates to another asset class. So while the S&P is up this year, and most major market indices around the world are we'll call it approximately flat, there has been a lot of turbulence underneath the current. And we think this is actually a good thing. So we don't have to have the entire market correct, because where there are pockets of overvaluation, those things are already correcting. Our view is that the two areas that have been white hot this year, one being technology stocks and the other being consumer discretionary stocks, will likely get hit before this rolling bear market is over. And when those two sectors correct, we think that that will probably be the end of this rolling bear market phase. So on slide 22, there's a lot of information here, and I really want to draw your attention to just a couple things. And what we're looking first and foremost at is the blue bar, and this is the next 12-month earnings per share forecast for various indices around. And you can see that blue bar is up very nicely, particularly for the U.S. S&P. We see it up nicely in Japan, and it's up in Europe, and it's up in the emerging markets. So earnings continue to go up, and that's a good thing. And now I'll draw your attention to the, I guess that's an orangish bar at the bottom, and that's the next 12-month PE. So that's the price to earnings ratio. So that's what investors are willing to pay per dollar of earnings. And it's unusual that we see earnings are going up, and yet around the world, investors are willing to pay less. So you can see there's been a compression of price to earnings ratios. That's also healthy for the market. And really what investors have been doing is sort of de-risking their portfolios. Same asset class, but just willing to pay less for these earnings. They don't, in history, oftentimes we'll see earnings go up and investors willing to pay more for those same earnings. It's just the opposite happening here. So that's healthy in our view. On slide 23, this is meant to show the very wide disparity in returns this year. Again, a lot of noise on slide 23. If I slide your attention to the left, this is just a baseline of zero performance at the beginning of the year, and then it's to the right. It's the performance through, I think it's actually this is June 30th. I'm sorry, July 6th. So we see that the NASDAQ now is up almost 10%. Small cap stocks up about the same amount. And we see the S&P as of this time period was up a little over 2%. High yield is basically flat. Long-term treasuries down a couple percentage points, and investment grade credit down almost 4%. So very, very wide dispersion, and our eyes are on the NASDAQ and the small cap, as I mentioned earlier, about these rolling corrections. I'm going to amplify our view for a moment on small cap stocks on slide 24. And this is just a relative chart, small cap stocks versus large cap stocks. It's a standard deviation, so it measures the extreme movements. And what you can see is that small cap stocks have done very well. We saw that in the performance numbers. And now when we measure that performance against large cap stocks, we see it's getting close to, if not already, in this historical valuation range. And it's really for two reasons. Small cap stocks have been viewed as a safe haven against the trade wars, because most of the revenue for small cap stocks is isolated to the United States, not 100%, but disproportionately relative to large cap stocks. So investors seem to think that small cap stocks are immune to the trading wars. And this is an area that Brian and I are focused on, and we're making a review, a determination about whether or not we want to adjust the weighting in your small cap because of this chart. On slide 25, taking a longer view in terms of earnings, Q1 earnings were so strong, we may have moved up the peak from what we thought was going to be Q3 to Q1. in terms of peak earnings. But what really matters, more importantly, there's a big deceleration going on next year that almost guarantees itself because the comparisons are going to be so difficult from the prior year. So that's something the market's going to have to digest. Where markets tend to be uncomfortable when there's a deceleration, more comfortable, of course, when there's an acceleration, because when it's decelerating, you never know where the deceleration is going to end, where the bottom's going to be. More to talk about next year when it comes to that. Slide 26. This is probably the most important slide in the deck, so I'm going to spend a few minutes looking at this with you. So this is the 10s versus the 2s. So we all can go out and buy a 10-year U.S. Treasury backed by the U.S. government. We can also go out and buy a 2-year U.S. Treasury backed by the U.S. government. So if you're going to buy something for 10 years versus 2 years, you expect to get a higher rate of interest on the 10-year, right? Because you've locked up your money, although both are liquid, you've locked up your money in a 10-year investment versus a 2-year investment. That's called the term structure of interest rates. That's the normal environment. So today, when we measure the yield that we all could get on a 10-year investment versus a 2-year investment, the difference is about 28 basis points, or about 0.25%. And that's really what this chart is measuring, is the difference between the 10-year and the 2-year. And why this is so important is because over time in history, when this relationship starts to come into play, in some cases you can see it turns negative, meaning the difference between the 10-year and 2-year is actually negative. You're getting a higher rate on the 2-year than the 10-year. We're pretty close. So for all effective purposes, we're there. And this, in the past, has signaled that the Fed is moving too quickly, raising interest rates too quickly on the short end. And long-term investors are predicting a slowdown or even perhaps a recession. And perhaps you'll remember in 1998, the collapse of long-term capital. We had this very similar scenario, and long-term capital, which had about $4.5 billion under management, had to be bailed out by a consortium of large U.S. banks. They happen to have $4.7 billion under management, just for the sake of history, and they had $125 million of leverage. Not that that's going to happen today, but it is a case in point in history where this inversion has caused some financial pain. So we monitor this very closely. The key for us is the Fed will be looking at this as well, and there's a reasonable chance that the Fed decides that they're going to back off from their tightening campaign, and that will be very, very good for risk-based investments, particularly equities.
What about the situation that we're apparently facing, that there's going to be increasing amounts of debt that the U.S. government has to sell? There's going to be a lot of it out there. Who's going to buy it?
That's a great question, and a lot of debate about that. And the investors are now focused on the earnings. And as long as the U.S. economy continues to do well, and it is blistering hot at the moment. We have sub 4% unemployment. There's about 7 to 8 million jobs that are unfilled. Investors are comfortable buying U.S. debt. And the Fed has Treasury has just issued quite a bit of debt last week, and it was very well received. But it is structurally a long-term concern, and this current administration has bet that the business cycle will continue to expand because of the tax cuts, and as long as there's U.S. growth, that should offset, because of the additional revenues, some of the debt. Great question, but right now the markets aren't concerned about it.
You're referring to the Fed unwinding their balance sheet, those sales, or the new issuance?
No, there's going to have to be more and more debt issued in order for us to operate, because even though the economy is responding ostensibly to tax cuts, the taxes that are coming in aren't meeting the needs of what the government programs are. So, in order to operate even at the current level of government services, that amount of debt that has to be sold to keep us going is going to be greater and greater.
I think, and Jim just alluded to it, they did have to issue more last week.
Yeah,
Which did drive up the 10-year a little bit.
Right. It's going to continue unless something happens. The projection is that's going to continue under the current tax structure. Yeah.
That's true. Which is long-term structurally why we run a very diversified portfolio. So we have quite a bit of money outside the United States as well, in both Europe and the emerging markets. Perfect segue into our thoughts about Europe. Slide 27. So, as you know, we have increased our portfolio exposure to non-U.S. equities. U.S. equities have been the best place to be for the last 9 years or so. And what we're looking at here, and the dark blue line, is European surprises, economic surprises versus the U.S. And there's a number of ways we measure economic surprises, and it's really in terms of earnings, it's GDP growth at the country level, and we amalgamate all that. And when what we're seeing here is the dark blue line has started to move up. So all that really means is that European economic surprises are accelerating at a rate greater than the U.S. economic surprises.
Surprises and good surprises?
Yeah, good surprises, yeah. So as I said, stronger economic growth, positive growth surprises. They're both good, but Europe has started to accelerate over the U.S. And if we look at the light blue line, we can see that European stocks really have lagged, and we think that we're probably at the beginning periods of a period where European equities can start to outperform U.S. equities. And we've looked at prior meetings, valuations of U.S. versus European equities, and that's one of the reasons structurally that we have a longer-term bias than we had previously to European equities. So any questions about our views on capital markets around the world? Last comment I'll make is that we have the midterm elections coming up, and the markets tend to be a little sloppy going into the elections, but the latter months in the midterm elections tend to be pretty good. So that goes back a long way in time, but fourth quarter in the midterm elections tends to be reasonably good. Any questions? If not, I'll turn it over to Brian, and he'll walk through tab 3, allocation and manager performance.
Great, thanks, Jim. And if there are any questions in the room, please, as we go through this, please raise them. And Jim, it's a little bit hard to hear some of the questions, so if somebody asks a question, maybe you can just repeat it so I can address it appropriately. But I think in your books, behind tab 3 is where we start to look at second quarter and year-to-date results for the Portsmouth portfolio. There is the first page there in that section titled Asset Allocation Summary. If you go to the second column from the left, all the way down to the bottom, you'll see we ended the June quarter just over $216.5 million in assets, $216.6 million. The column to the right of that shows the allocations to the various portfolios and asset classes. And then the column next to that shows our target allocation. So you'll see we're targeting 38% to U.S. equity, 32% to non-U.S. equity, and so forth. We ended the quarter in line with our target asset allocations on an asset class basis, albeit a little bit overweight to U.S. equities, 2.6 percentage points overweight, and the corresponding underweight to all the other asset classes. So that relative difference in how our assets were actually allocated versus what we were targeting, slightly overweight U.S. equities, helped us a little bit during the second quarter, as Jim talked about. U.S. stocks in particular outperform places like emerging markets and the developed world, as well as fixed income. On the next slide, we have a look at total fund performance.
We have one question.
Regarding the target allocation, are we planning to revisit this given the new, formally hiring you as the manager? Do you want to go back and look at this and change managers and things like that?
I think now is a good opportunity to relook at that for a couple of reasons. Yes, we have we'll have shortly a new agreement in place. But secondly, with passage of time and actuarial valuations, I think a fresh look at the liability side along with the assets makes sense. The last time we looked at this was late 2016, so a formal review every 3 years, which we're coming up upon here, makes sense. So I think there may have been Landon that asked the question, but yeah, it's a good opportunity to have a fresh look at everything.
And then two more quick things. So we're overweight U.S. relative to our target allocation, but are we underweight a little bit U.S. relative to the sort of the global market weighting?
If you look at global public equity markets and how much is represented by U.S. stocks versus the rest of the world, it's roughly 50-50 in round numbers. It varies, plus or minus 5 percentage points one way or another, depending on which markets are outperforming the others, and we're just kind of coming through a recent period of U.S. equity market outperformance. So you can think of the global equity opportunity set as about 50% U.S. equities and 50% non-U.S. equities. And we think that's a good starting point to start the conversation. There's a lot of research out there, academic research out there, that suggests owning something called the market portfolio is the best portfolio to own, the best risk-adjusted return in the future is likely to come from owning this market portfolio, which is owning the assets as they exist in the market. So we think our exposures are between U.S. and non-U.S. equity are pretty close to what that market represents. We might be off, again, plus or minus, a few percentage points here or there, but our allocations are pretty close to what the overall market looks like. There is one
Brian, I'm sorry, we're losing you.
Oh, can you hear me?
Better, yes. Not so good now.
Let me see if I can step somewhere else and
That's
get a little
good.
bit.
That spot's really good.
This is better?
That's great.
Okay, perfect.
Perfect.
The one big difference in how our portfolio is allocated relative to what the market looks like is a fairly significant overweight to emerging markets. And as Jim talked about, it's our view, despite all the the saber rattling on trade policy that's going on. It's our view that over a long period of time, emerging markets are well positioned to outperform the developed world because those economies are growing at a much faster clip than places like the U.S. and Europe and Japan. But in addition to that, the valuation levels of emerging markets are much more attractive than they are in the rest of the developed world.
What I'd like to see on this page, or somehow if you can find a way to show it, is what actions, if any, were taken during the quarter as far as the weightings to the managers, if you took an active approach to make a change, and then also maybe also what your thoughts on each of the weightings, your forward-looking thoughts. So for instance, for the quarter, if you increased or decreased the overweight, underweight to any of the classes, and then if you're gonna maintain or change that in the future.
Yep, happy to do that. Any other questions on asset allocation?
I think I can say, I don't believe there were any allocation changes during the quarter.
Correct.
Or second quarter.
And
I think the last.
I assume your plan is.
Sorry, Brian, one more. Sorry.
Your plan is to maintain. I guess you already said this, to maintain the overweight to emerging markets.
We would suggest that. Yeah. Mm-hmm. The last shift in allocation that was implemented, I'm going to get the dates wrong here probably, but I think it was in February, where we moved, I think it was $11 million out of the Schaefer-Cohen portfolio into the S&P 500 index fund. A lot of the bigger structural shifts that were made were, for example, the overweight to emerging markets was implemented in the middle or fall of 2017. If you I'm hearing any other questions on asset allocation, if you flip the page, the next page is total fund performance summary. So here's how the fund performed for the second quarter, year-to-date, and longer-term periods. We were slightly down in the second quarter, down 0.4%. That puts us down a little bit more than 1% for the year-to-date period, and you can see the 3 and 5 year numbers, 5.6 and 6.1% respectively. We compare the total funds returns relative to two benchmarks. One is sort of the weighted sum of the individual manager benchmarks, and that's shown directly underneath it. You can see for the quarter that performance measurement benchmark was up 1.8%, year-to-date up 0.6%, and so we underperformed by 2.2% and a little bit less than 2% for the year-to-date period. We also show what we call a policy portfolio. So a policy portfolio is basically what our target asset allocation is, and then we use broad benchmarks for each asset class. So for example, we have a 38% weighting to U.S. stocks. So within that policy portfolio, we take 38% of the return of the Russell 3000 stock index. And we do that, we go through that exercise for all of the asset classes in which we have investments. And that portfolio's return was about 0.8%. So we underperformed that by 1.2 percentage points during the quarter. And you can see the longer term period as well. We'll talk about the reasons for some of the underperformance. In fact, we'll do that on the next page. So if you flip to the next page, there's a series of 4 charts there, and on the upper left-hand side, there's a chart that's titled Attribution Analysis. So this takes our total funds return of minus 0.4%, compares it to the policy portfolio's return, which was 0.8%. And if you look at that total bar in that graph on the upper left-hand side, you'll see minus 1.14. So we underperformed that policy portfolio by 1.14 percentage points. Now, what were the causes of that underperformance? And you can see two bars that stick out in particular, and it's the first two at the top of that chart. So our U.S. stock investments in aggregate detracted about 0.5% relative to that policy portfolio. And why is that? Well, it's largely because the Schaefer-Cullen portfolio has been defensive in nature and has underperformed the broad market. In fact, if you just looked at the Schaefer-Cullen portfolio, even though we've been reducing it over time, it accounted for 42 basis points of the 49 basis points of underperformance. So virtually all of the U.S. stock portfolio's underperformance is coming from the defensive nature of that portfolio and the fact that it had underperformed in the second quarter. I'll show you those results in a minute. The other portfolio that didn't do well during the second quarter on the U.S. stock portfolio is the Goldman Sachs portfolio. We'll look at those results in a minute. That accounts for the other 7 basis points. The non-U.S. stock bar, you see it's minus 0.6. So in aggregate, our non-U.S. stock investments underperformed the non-U.S. stock market by about 60 basis points in the second quarter. And as we've talked about, the big difference between the construction of our portfolio versus the broad non-U.S. equity benchmark is a fairly significant overweighting to emerging markets. And as Jim talked about and reviewed when he talked about the second quarter results, emerging markets were down about 7.75%, while the developed world was only down a little bit less than 1%. So that significant overweighting had a material impact on our second quarter's results. In fact, if you looked at of that 60 basis points underperformance from our non-U.S. equity portfolio, how much comes from our overweight to emerging markets in the second quarter, it's about 57 basis points. So virtually all of the underperformance on the non-U.S. stock side we've experienced in the second quarter is coming through from that overweight to emerging markets. Now, that overweight to emerging markets has added value for us since we've had it in place. Again, we had that position fully implemented, I think it was September of 2017, and so it's worked since then. Just in the second quarter, it was a little bit challenging of a period for emerging markets, given a lot of the trade rhetoric, and as Jim talked about, increasing interest rates in the United States. You can see much smaller impacts of all the other stuff or all the other asset classes below that. Are there any questions about that analysis? We'll talk about individual portfolios in a second, but I wanted to spend a little bit of time kind of talking about why we underperformed by 1.2% in the second quarter. There are no questions, then just a couple other comments on this slide. If you move from the upper left-hand graph to the upper right-hand graph, we're looking at total fund results relative to the policy portfolio on a risk-adjusted basis, where risk is on the horizontal axis, return is on the vertical axis. Basically anything that falls below the line that you see there, that diagonal line, has lagged on a risk-adjusted basis. So in our case, we've had less volatility from our portfolio, so our point on the graph is to the left of the policy portfolio. It's also below, so it's earned a lower return. So on a risk-adjusted basis over the last 5 years, our portfolio has lagged the policy portfolio. Again, primarily a function of the defensive nature of the Schaefer-Cullen portfolio and the material weighting we've had to that in periods, really prior to the last 12 months. Only other comment I'll make on this page is the graph that's directly below the risk return graph, which is comparing our returns relative to the universe of public funds. This is often interesting for public fund boards to look at. We don't think this is a good primary benchmark to try to exceed, but it's interesting to look at nonetheless. The primary differences of how our fund performs relative to other public funds is going to be driven by asset allocation differences. And you can see that over kind of all periods measured, we're plotting in the middle of the bottom quartile of returns. It's our job, mine and Jim's job, to start to outperform that policy portfolio, and we think when that starts to happen and when we start to do that, we'll see better results relative to the universe of your peers. Any questions about any of that?
Yes. The upper right, the risk return, and you may have done this, but it's in the past, I guess. I'd like to see that on a prospective basis. I know you have developed your own capital markets outlooks. Where's the, on a go-forward basis, where's the policy portfolio versus where's the policy portfolio on a forward-looking basis? What's our expected return if we don't do anything?
So it's more on an expected rate of return of the portfolio's current allocation?
I guess the policy versus the current on a go-forward basis.
Yep. We could do that.
Mm-hmm. I mean, I would, once you have sort of full control over the portfolio, I would expect that your allocation versus the policy would be to the upper left.
Correct. In large part because of our exposure to EM. I think one of the things that we'd like to do is to meet with the investment committee and really rework how we display this. I know we've had some conversations in the past about what the policy benchmark really is, and there's been some debate about whether that is even relevant to this group. And I think we should, my own view is that we should start draw a line in the sand and start it on a particular path going forward the way everybody agrees, coming out of the investment committee. The issue that we're dogged with here is the Schaefer-Cohen premium dividend allocation to equities versus, as Brian said earlier, the Russell 3000. And since the great financial crisis, the markets have been straight up. So if you've been defensive in any regard, that's been punitive. But that's really not fair to the board and the prior investment committee, because at that time, the finances of Portsmouth here were very different. There was a bond offering, and it's not fair to assume that the board or the investment committee would have put that money into the market. So there was a conscious decision to put money into the markets, 35 blue chip companies that yield about 3.5% dividend yield. Cash flow was really important that time. And then there's another 3.5% in Schaefer-Cohen that comes from option premiums that are written on about half of the underlying stock. So it's an entirely different strategy. And I would just like to, at the committee level, to formalize what the right policy benchmark is for us. And then I think we're happy to do a prospective return. Any other questions? Okay, Brian?
Okay. The next two pages, or the next two slides in your book, take a look at individual portfolio returns. Again, we're showing second quarter year-to-date 3- and 5-year numbers for each of the underlying portfolios. So The first one there being Schaefer Cullen. I talked about a lot of the underperformance that was coming through from our aggregation of U.S. stock managers was a result of this portfolio's underperformance, and it returned 0.7% in the quarter. Its benchmark was 3.4% for the quarter, right in line with what the S&P 500's return was during that period. Over the year-to-date period, this portfolio was down 3.5% versus its benchmark of 1.8%. You can see the longer-term results there as well. Jim just kind of alluded to the key issues here with this portfolio. It is defensive in nature, and as we're coming out of the global financial crisis, U.S. stocks in particular went straight up. So to the extent that this portfolio was defensive, for really two reasons. One is that the stocks that Schaefer Cullen buys are what are generally referred to as value stocks, so large cap value stocks. We are just in the midst of a pretty long run where growth-oriented stocks and companies that are growing their earnings much more quickly than the overall market are doing much better than value stocks. Value stocks tend to be more of a defensive play on the market because they pay dividends, because they're well-known companies that aren't necessarily growing their earnings as quickly as companies like Facebook or biotech companies or some of the other technology companies. So they're defensive, number one, in terms of the stocks they buy. And then number two, they do sell options on about 30% of the portfolio, which tends to cap the upside in the stocks that they do own. So those two factors in particular drive the defensive nature of this portfolio and has caused it to lag over time. Directly below that, the Vanguard Institutional Index Fund. So this is a passive investment vehicle. This is a manager that's not trying to beat the market, only secure the market's returns. And you can see that they did that during the second quarter and year-to-date periods. When we talk about position analysis on a couple of prior slides, I talked about the other portfolio that struggled during the quarter was Goldman Sachs portfolio. Its return was 3.8% versus a Russell 2000 value index of 8.3%. Despite what I just said about Schaefer Cullen, about value stocks underperforming growth stocks, the flip side of that was actually true in the small cap space. So small cap value stocks in the second quarter did better than small cap growth stocks. And the deeper the value the company was in the second quarter, the stronger the return. Now, Goldman Sachs is definitely a value-oriented manager, but they are not as what's called as deep value as the Russell 2000 value index is. So although that underperformance in the second quarter looks large, and it is, it's really a function of the manager style relative to the benchmark against which we measure them. And that underperformance in the second quarter is driving a lot of the underperformance of the longer-term periods as well. We offset the value-oriented investment style of Goldman Sachs with a growth-oriented style of Rice Hall James. So this is a manager that operates in the small to mid-cap space in the U.S. equity market, but buys different kinds of stocks than Goldman Sachs does. And they had a solid quarter at 5.3%, right in line with the Russell 2500 Growth Index, 5.5%. Over the year-to-date period, we're up almost 12% there, about 400 basis points ahead of the Russell 2500 Growth Index. The next two managers that are shown there, the Euro-Pacific Growth Fund and the Lazard International Equity Concentrated Fund, both generated the same level of return in the second quarter. They were down about 2.8%, right in line with their benchmarks return. The MSCI All Country World ex-US Index down about 2.6%. Over the year-to-date period, the Euro Pacific Growth Fund down 1.8% versus the index of down 3.8%. So 200 basis points of excess return during the year-to-date period for the Euro Pacific Growth Fund, and you can see the longer-term returns there look pretty good relative to the non-U.S. equity benchmark. The next manager there is our emerging market manager, our dedicated emerging market manager. Artisan Developing Market Fund was down 7.5%, saved a little bit of value relative to the MSCI Emerging Market Index, which was down closer to 8%. So even though the market was, even though this portfolio was down significantly, it went down a little bit less than what the overall market did. But that overweight to emerging markets relative to developed non-U.S. equity markets really dragged our non-U.S. equity markets return below the broad market. Any questions about the equity managers before we move on to some of the fixed income managers?
Nope.
Hearing none, I just ask the board to flip to the next slide where we look at fixed income results and some of the other managers as well. So the first three portfolios there, BlackRock, Lord Abbett Short Duration, and Carillon Reams Unconstrained Bonds. These are our U.S. fixed income managers, and you can see their returns vary quite a bit. BlackRock was down about 0.1%. The Lord Abbett Fund was actually up 0.5%, and the Reams Fund was down 0.2%. And right below that, you can see the benchmark's return. I think it's important to think about this collection of managers in sort of a portfolio context. So we consciously structured the weightings to these three managers based on a view that interest rates in the United States were going to rise. And so what we have with Lord Abbett and Reams in particular tends to be a little bit shorter duration portfolio than what the underlying index looks like. So these three managers in aggregate have a short duration profile and should outperform in periods when interest rates rise. And as we talked about, and as Jim talked about, in the second quarter, interest rates, the 10-year Treasury yield rose a little bit in the second quarter. We've been in a rising interest rate environment for the last 12 months or so, maybe a little bit more than that, not by now, 18 months or so. And so this portfolio has really worked for us. In fact, if you look over the year-to-date period, and we have roughly a third of our fixed income assets in each one of these managers. In aggregate, this portfolio was down about 0.7% for the year-to-date period, when the fixed income market in total was down 1.6%. So it's performing exactly like we expected, and has done well as interest rates in the United States have rose over the last several-month period. The portfolio below that is a global bond portfolio that's managed by Templeton. Its return was down 2.5% during the quarter. Its benchmark was down 2.8%, so a little bit of excess return generated there. Year-to-date period, you'll see a similar level of outperformance. Not a lot to say there. This is a global bond manager that tilts the portfolio to different regions of the world based on expectations for interest rates in those different regions, what's going on with currencies. So there's a lot of opportunity for this manager to add value. I would say that the performance pattern of this portfolio has been pretty volatile over time, and the month-to-month and quarter-to-quarter swings get a little bit you don't see that as clearly by looking at the 5-year number, but there are periods of time where this manager can outperform, or typically outperforms or underperforms by a significant margin. Just so happens over the last 6 months or so, the volatility of this portfolio has been relatively muted. The next two managers are REIT managers, one a global REIT manager, Principal Global REITs, and then the Vanguard U.S. REIT Index Fund. So REITs in the second quarter did particularly well. The index was up about 10%. Our U.S. REIT index was up almost 9%. And the global REIT index was up about 3.2% in the second quarter. The primary difference between global REITs and U.S. REITs, as Jim talked about in the second quarter, the U.S. dollar rose in value relative to other foreign currencies, and so the global REIT portfolio underperformed the U.S. REIT index during that period of time. And then the last portfolio we have here is the managed futures portfolio that's run by AQR. Think about this as kind of like a hedge fund, but it's packaged in a mutual fund vehicle. It tends to do poorly when equity markets in particular are rising, but where its value shines is when risky assets, global equities, and U.S. equities in particular tend to fall in value. We haven't had many of those periods of time since this manager's been in place, which is why you see some pretty negative returns over the year-to-date period and three-year period. So with that, I'll stop to see if there are any questions about individual portfolios returns. There's there's a few pages on each of these individual portfolios that are behind these exhibits that look at different kinds of analyses, longer term track records of these portfolios. But I think in the interest of time, I'll just stop there and see if there are any questions, or if there. I'm happy to address some of the other analyses of the individual portfolios if there are any questions there as well.
I'm not seeing any. Brian, did you have anything else to say before we let you go back to your vacation?
No, just that, again, just to reiterate what Jim and I said, we're delighted to continue to work with you and look forward to engaging on review of exposures in light of current liabilities and market conditions and outlooks, and so just again delighted to be continuing to work with the board.
Well, thank you very much for taking some time out, and we appreciate the information.
You bet. Thank you very much. Have a nice weekend, everyone. Bye-bye.
Enjoy the rest of your time, Brian.
Thanks, Jim.
Thank
Bye.
you. Bye.
Are we ready for Tom? John Hancock?
All right. Thank you, everybody. So I'm pretty confident. I know this book looks pretty big, but I can get through it in about 10 minutes or so. Just a couple of comments on that from I do want to give just touch base real briefly with regards to an organization update. I do want to talk specifically about some of the things we've been doing, partnering with yourself for this year, and then what the rest of the year looks like, and ask a few questions on some scheduling and planning around that. And then I just wanted to highlight a couple of new enhancements that are available out on our participant website, and then also what we're doing with the client plan sponsor website. But again, some of these presentation decks on those are a little lengthy because our compliance group likes us to keep the entire presentation together. Some of it doesn't apply here, and I can just hit a couple of high points. So with that said, in tab 1, as I've talked about earlier in the year, from an organization standpoint, again, as a reminder, John Hancock reports up to Manulife Financial, which is a Canadian company. There was a change made earlier this year that really took the whole structure of the organization and framed it from creating divisions that are focused on lines of business globally. So we fall under, we being John Hancock and Retirement Plan Services, roll up to the Asset Wealth and Retirement Group that has a global perspective as one of the leading retirement plan providers in Asia, Canada, and in the U.S. That's a great thing for us because it's allowed for increased synergies to leverage some of the tools and resources that we bring to our individuals that we work with and customers here in the U.S., and then vice versa from the Canadian markets. We've been able to leverage some new technologies that have been introduced in Canada throughout the year, one being a financial wellness assessment, which is available to individuals in your systems. So there's just updated information from an organization standpoint. In tab 1, on page 6 too, there's also information that talks about something that we call our Thrive initiative, which is really focused on driving down expense to increase profits, create efficiency, and hopefully deliver a better solution for the customers we work with. And that process is well underway. On page 7, it highlights some of the roadmap items that we're working on. A number of these are 401k or defined contribution focused, but one area that I'll spend a couple of minutes just giving a few bullet points on in a moment is highlighted in the middle column here under holistic and enduring journey, which is we are just introducing this month a new total financial wellness data aggregation tool through the website that will be available to defined benefit participants such as City of Portsmouth as well, for those that might be looking for a tool to use. So I'll comment on that in just a minute. All right, more importantly though, I think in tab 2, so I just wanted to list out some of the initiatives that we've worked on during this year and some of the updates that have been given in these meetings, just because I know not everyone can always attend these meetings when they do come up. So if they're, and I know minutes are provided with overviews, but just to highlight some of those, so if additional questions do come up, you can get a sense of what has been discussed. So quickly going down, obviously we participate in these quarterly board meeting updates, providing hopefully what makes some positive contributions from an overview on the retirement systems, the plan expense, and then just bringing awareness of what is new and available to individuals in the system. Earlier in the year, I went through an annual service structure and product offering update with committee changes occurring again here towards the end of the year. It'll probably be worthwhile to do that again, whether that's towards the end of the year or the beginning of the next year. And again, that's just to give all those individuals that are on the board an awareness of what we do from an overall service perspective. Data security overview was provided at the last meeting, so all of the investment that goes into a lot of the security initiatives we've undergone. And then also we work quite a bit with Ms. Gooden's group on looking at efficiencies and administrative opportunities to streamline process, whether it's internally here at the City of Portsmouth or back in our offices. And I know one of the things that was just recently changed and discussed with an update to the board was reducing the number of banking institutions that individuals can direct their pension benefits into. Again, just actually brings it more in line with industry standard, streamlining practice, and hopefully creating a little bit of efficiency there. A couple of important items that are coming up in the second half of the year. One being the actuarial review. So that's item 6. In the past, generally the timing of that has been mid-October. We would probably look to maintain that same schedule. I know last year the board was gracious enough to move their meeting by a week later into the month to have us come in just to allow the actuarial team a little more time to finalize reporting. And that's where Andre Stewart will come down, the assigned actuary, and go through that information. So, I think that scheduling worked well for us last year. So I'd like to recommend that we follow a similar approach here if that ultimately can work out. And again, I know there might be the potential of some new individuals coming in, so adjusting schedules.
I just have a question about that.
Yeah.
So that's where annually you revalue the liabilities?
Well, so what happens is the fiscal year ends, and the plan year ends the end of June, and yes, a full valuation is done to look at the liability, expected cost and expense versus cash flow and what is the funding level of the system. And then can also, as Brian mentioned earlier, I know that information is generally used from an investment manager standpoint to look at appropriate allocation.
Because I know, I guess annually you do that formally. Are you able to provide an estimate of how the liabilities have changed from quarter to quarter?
We can. So we actually do.
Benefit payments and discount rate, things like that?
Yeah. There is a tool available. We partner with an outside vendor. It's called Faro. It was something we had presented to one of the past CFOs. It can be something we can revisit and see if there's some value using that or bringing those updates to this group.
Because we haven't, I've only been on the board for maybe half a year. We haven't really talked about funded status and how that's changing. And I'd like to see the sort of the picture of the funded status, how it's changed over time compared to our expected return and what contributions we're going to make. I think when you sort of paint that picture, it's going to show that we're on sort of an unsustainable course, and we need to keep that in mind that at some point in the future, and I don't think we're majorly underfunded, but at some point in time, the money's going to run out, and I don't think investment returns are going to be enough to sort of make up that gap.
Yeah, and again, and that we absolutely, that's the information that is presented. We can, what I can say is due to the structure of the system and the fact that there's such a small active population left, there isn't a lot of variability throughout the year with regards to, that valuation, but we definitely can look to add in some estimates on a quarterly basis.
I mean, the major driver is just going to be the change in rates, right?
Right, which really isn't having a lot of impact because a lot of the liability is locked in since the vast majority of the population is in term status and either being paid or is vested.
But the discount rate.
Understood.
What is the, do you know off the top of your head what the latest discount rate was that you did last year, the formal?
I don't. I'd have to double check to see what it was.
So I guess since almost everybody's in payment status, the sort of duration of the liability is not that long.
No, and this is why, again, I know we talked earlier, Jim and Brian talked earlier about a really defensive position from an allocation standpoint. A lot of that was also driven by that fact, that a lot of that is locked in. And we've done different analysis over the years to look at whether or not, some of the assumptions should be modified. And quite honestly, they really, even changing things there doesn't have much of an impact at all. But you're right. I mean, this is a declining system. The expectation is that the overall assets are going to continue to decline. That's an expectation. It's just obviously keeping up with the needed cash flow.
And we do it in October in anticipation of the budget preparation. So if there is anything drastic that's called to our attention, we can make recommendations to council if we feel like it's necessary.
Right, and I know earlier this year, there was some updated expense information provided that went to council, and Andre actually came down and attended a meeting.
Looking at the October suggestion,
Yes.
moving it a week is what you were, or was it more than a week? Or towards the end of the month, or just a week?
I believe last year it was moved just a week.
So it was like the third Thursday, wasn't it?
Yeah. So this year it would be the 18th.
The auditors come in on the 1st of October, expecting a CAFR. I mean, a rough draft. And so being new, I don't know what your timeline is and whether we provided you everything that you need.
Yeah.
But the expectation is that we'll be ready for them when they get here. So.
Yeah, so I'll circle back, and I know, again, Andre has worked very closely with the finance department to ensure if there are estimates needed that we can provide those.
Okay. Thank you.
But that's good to know, just to have that confirmation on the beginning of October. So the potential for October 18th, again, I will also check internally just to see if there's any opportunity to move that up, or if that's the date that makes sense, and then come back to this group.
So if it is, assume it's October 18th, then Brian and I would like to have a meeting with the investment committee to review our portfolio assumptions, asset allocation, risk level, et cetera.
Before or after the?
After
the
that
18th.
information is made available to us.
That makes sense.
Okay.
One more question. So I think the city historically has been contributing, and I forget the letters, but the actuarial.
Actuarially determined contribution.
Right. What can you, at a high level, explain what that is? What are you basing it on? Is that getting to a fully funded level over a certain period of time?
I mean, it's over the life of the system, would be just targeting to ensure that the expected payments, there's adequate cash flow for that. So, with the system the way it is, I mean, there isn't really a short-term or really mid-term goal of getting the system to, quote-unquote, a fully funded situation based off of where the funding level is. It's more around of maintaining somewhere in the neighborhood of 80% funding level. That's been the expressed goal here, so that, along the period of time that can be targeted.
And for public plans like this, 80% is an important sort of number. Does anything happen if we're under that?
No, so it's not like the corporate world where restrictions can be put in place on the retirement system. So what we generally do, and what the city has generally done, is look to the corporate regulation side to kind of drive the targets here. But there is not a level that impacts on the municipality.
So you take into consideration what our investments are and apply an expected return. You know what the benefit payments are, and then you say, what do we need to contribute to stay at 80%?
Yes.
Okay.
And in the past, unfortunately, we haven't been close to that, and that was one of the reasons why we issued the bond.
The bond.
It might be of some value to Landon and Mark if they got a couple of those reports, if they haven't already seen them, that sort of gave the conditions of the situation as it was like 4 years ago. And then perhaps historically, maybe after the last October or November that we got from Andre, just so you'll kind of give an idea, because, I mean, the expectation is that they really only have to fund this for another 20 years, and most of us will be gone. So that's really what they're looking towards, is being able to pay for the last person to get a benefit. And then there may or may not be a little bit of money left over, and then it would go to
I mean,
finish.
eventually funding to maintain 8% is going to not work anymore.
Well, there was a graph that we got
Yep.
some time ago that actually showed, I mean,
Yeah, and Andre included it in
yes,
last year's
report
overview.
to
Yeah.
us, yeah. And that might be helpful, because that shows you exactly like where the nadir point is, so to speak. And what they project will be like, this will be the very
In
end.
year 2030,
Right, right,
we're going to need money.
right, and there won't be any more retirees, or there'll be very few. So, I mean, that's kind of what that,
I believe that I've got an electronic copy and I can send it to you gentlemen, but it kind of went up a little bit and then it
Right.
just starts going down, 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 down.
right,
Right, and it's going to adjust significantly towards the end as more beneficiaries die off is what's going to happen.
Correct.
So, ostensibly, you may have you may still have a significant percentage liability, but that percentage isn't going to be based on 300 people anymore. It's going to be based upon 30 people. So, yeah,
Right.
but we need to keep an eye on it.
right.
All right.
Thank you.
The other item, which I'd brought up early in the year, which we had done about 2 years ago, and I think makes sense again with some of the significant changes with the board, is to provide fiduciary training. So we can give overall training. You know, again, it's important from a board standpoint or a committee standpoint to document that the attendees have been trained on what it means to be a member of a group like this, the fiduciary impact of that, what is a fiduciary, who may be considered a fiduciary. So again, it's been a couple of years. I think it probably makes sense. That's something that we can come in and provide. Again, it's just talking about timing, and I think it would probably make more sense to do that once a better understanding is known about
The transition
the
of the
transition.
board.
Yeah. All right, and then
Sorry, one last question,
Yes.
if I may ask. Earlier in the conversation today, there was discussion about turnover at the board level, and maybe you don't know the answer to this question yet, but will we know the substance of the investment committee post an October 18th meeting?
Well, you will still have at least one person on the investment committee, and depending upon whether or not they're able to find replacements for those of us that have an investment of some kind in the system, because again, as Mr. Ashby pointed out, they'll try their very best to try to find either a retiree or a current fire and police or current employee to take the place of the three of us, because all three of us are actually going to be going off. And, if they can't find anybody within the pool, then they'll start encouraging citizens that hopefully would have some kind of vested interest in city
Understood.
involvement. So I think we're probably not going to know anything until next year, I bet, because I know in the past it's taken them several months to be able to find some replacements. But if they're actively looking now and seeking, I mean, hopefully that's an encouraging sign.
Great, thank you.
If Deborah White, the city clerk, did send me the request for information on the people that were rotating off, and I did send that back to her yesterday.
Okay. Well, I have a question that I'm going to ask you after the meeting, so. Okay.
All right, let me just, as a reminder for those that have seen this, on the next few pages, 11, 12, 13, so this is the plan expense overview that we provide on a quarterly basis. So again, just left to right, the two systems are referenced, what the average investment expense is for the systems in both the basis point and dollar standpoint, what our required revenue is. So the John Hancock RPS group, our cost is 6.5 basis points. And then adding those two together to get to the total expense, you'll see that those two numbers don't add up equally. It's actually a little bit less, and that is because there are a few investments that the systems use that provide some revenue sharing, and that's where the investment managers have agreed to provide some of the revenue that they take in back to the plan, and it can be used to offset ongoing cost. So that's 6.5 basis points, and this goes to our quarterly invoice process. We take that 6.5 basis points against the assets in the system. It's divided by the number of days in each quarter, and that essentially becomes, the quarterly invoice. So that information is detailed on pages 12 and 13 and show the funds, what the expenses are. And then the last column shows what the revenue sharing credit is that comes back into the plan to offset those expense amounts. And again, this is set up intentionally to have a basis point cost structure because we fully understand that the systems are decreasing in value. So this reduces our costs because our costs should go down as the number of individuals that we're servicing goes down. So it's set up that way as a reflection of that. Any questions? All right, let me just, in the interest of time, I won't go through this, the additional information in this book in detail, but I just wanted to give an awareness. So in tab 3, we are just introducing, as I mentioned earlier, a new enhancement online. Again, this isn't as applicable to a pension plan, especially one that has as many non-active participants. We know the ongoing utilization of the website isn't all that strong for individuals that are receiving payments. But we are introducing, actually within the next week or so, a financial management and aggregation tool. We previously had a partnership with another firm that was acquired and changed their business structure. So we have built a new solution in-house, partnering, and it's a John Hancock branded aggregation financial management system. So if someone does want to go into the website and set up an opportunity to pull in all of their financial accounts that are held in other organizations in one consolidated place, they can do that within the Access Online, and then it also allows opportunity to create budgeting tools, savings goals, et cetera. Again, I wouldn't see much utilization from this population, but it is available.
Is there going to be something sent out as kind of a notification to the employees about this once it's fully activated?
So we're doing we're not doing a mass mailing on it, but we are, for those individuals that have emails with us, we are notifying them in that way. And there'll be information that will be made available on the website itself.
Okay.
So that there is some awareness to it.
Okay.
So that is the majority of the information in tab 3. There is a whole learning center out on the web as well. We've made some enhancements to that. And I think some of this may have been touched upon. We did come down in June and we did some meetings for individuals. The opportunity was put out there, especially due to some of the changes on the benefit payment structure. There weren't a lot of individuals that came to the meetings here, but we did have somebody on site. I think around 10 individuals came in, but the resources, there was an overview of the resources that was provided at that event as well. There's information in here that really applies more to defined contribution plans, where we're creating enhanced retirement spending tools at the participant level. And then in section 4, for those that use the client or plan sponsor website, so those in the finance and HR and benefits groups that may have to contact us or work with us through that site, that's going through a full refresh and enhancement. We will be introducing the new version of that towards the end of this year. So as we get closer to that, we'll definitely look to set up calls with those individuals that look to use that to obtain information. And that's it. I mean, I put in the standard quarterly reports in the back. I know we talked about reconciling the actives and getting that in line. Brian obviously covered the allocation and overall asset holdings information and performance. And then the other thing we show is the plan activity for each system on page 54, for example. So again, looking to the cash flow situation, as a reminder, a total of, I believe, just over $7 million comes out on a quarterly basis from the systems when they're combined. So that's significant net cash flow that comes out, and again, ultimately, based off of the status of the system, the assets will continue to decrease. Anything else? All right, thank you.
Thank you very much, Tom. Appreciate it. Anybody have any other questions? If not, can I have a motion to adjourn?
Motion.
Second?
Second.
All those in favor?
Aye.
All right, we stand adjourned. Thank you, gentlemen, very, very much. Appreciate it.